Well, the major averages are lower now for the first time in 3 days as investors brace for earnings season, and it is likely to be an eventful one. Legendary investor Leon Cooperman saying on our air earlier today that we won't see normalized earnings for 2 years. For more, let's bring in Nela Richardson. She's the chief investment strategist with Edward Jones. Jerry Castellini is president and CIO with Castleark Management. Jerry, do you agree with Lee Cooperman that we're not going to see normalized earnings or earnings basically unaffected by this pandemic for 2 full years?
I think that's pretty far out. I mean, there's so much we don't know right now, Tyler, right? We don't know when the virus is going to have its full impact. We don't know what employment's going to be. There's a lot that you'll probably learn in the next 6 to 8 weeks that will determine that runway. The aggressive versions of it could have you normalized by the first quarter next year. But I wouldn't take out that possibility. I would just put it at the far end. I mean, just remember, no one has ever thrown $7 trillion at any economy, let alone this one, and let alone now. And we have no way of understanding that until we get going into next year. I mean, it's a powerful amount of investment.
I found myself wondering, frankly, how much of that $7 trillion really makes it into the economy and how much spillage there will be. That's for a different time and place. But, Jerry, you also say that most of the negative impact from the coronavirus is already being discounted in the market. How can you say that if we really don't know what the duration of this is going to be, what the potential for re-outbreaks is going to be? At this early stage, how can the market know what the actual discount ought to be?
Well, again, discounting is taking the highest probability outcome and applying some degree of uncertainty to that. So the things that we're not certain about, we don't know how long this is going to last. But we also aren't sure at all how big this impact will be from the stimulus. I mean, Tyler, $7 trillion is a third of the entire year of GDP for the U.S. economy. We released that here just in the last handful of days. If you think about having, you're crossing a river now, instead of wondering about whether the river's 10 or 20 feet deep, you're pretty confident it's only 3 or 4 or 5. So you'll be at waist-high level at worst. And I think that's the question that the market has finally resolved. It pretty well is discounting this hard shock, right, that's going to come to employment. It's going to come to earnings. It's going to come to a lot of different aspects of the economy. But a lot of those things are captured in stocks right now.
Yeah, let me bring in Nela to get her reaction to what you've just been talking about. But also, let me just tee it up with a question. What will the effect on the economy and the market be if unemployment in the United States stays above 10% and, Lord help us, maybe even above 15 toward 20% for any extended period of time, say through the remainder of 2020?
Well, it will have a big negative effect, as you can imagine, Tyler. Remember that going into this pandemic, it was really the strength of the consumer that we thought would push this expansion forward. And the bright light of this consumer spending was the labor markets. We were looking at 50-year lows. So to see going from 3.5%, under 4%, all the way up to double digits, some extremes being above 20%, it's shocking. But it's all about now, not just the magnitude, but the duration. And that's why I would like to connect with the previous what Jerry was saying. That stimulus can arrest some of the worst effects, the most extreme effects of having this dislocation in the labor market. One of the most immediate ways is unemployment insurance. That part of that benefit package that extends it, makes it easier to get, and amps up the payments on a weekly basis. That can help assuage some of the worst effects of really extreme unemployment rates.
Yeah, I think of the stimulus as kind of like cardiac paddles to resuscitate a patient that has been basically artificially put to sleep for a while here. But once those paddles have activated the patient, that doesn't mean the patient is healthy again. Nela, I know in a previous life you paid a lot of attention to housing, and the health of the housing market is a big yardstick of Americans' wealth. And the health of the housing market is also highly, highly dependent on people's jobs and sense of job security. What do you see happening for housing?
I still pay a lot of attention to housing. And the reason is housing has been the sector that has traditionally, historically, led the economy into and out of recession. Housing sector, like all sectors in the economy, is more or less on pause as all these social containment efforts play out. But housing will be a sector to watch in terms of the strength of the overall rebound with these very, very low interest rates. Remember, housing is also the primary mechanism, or it has been, for the Fed policy to hit Main Street. Right? It's through the housing market that the Fed policy plays out to ordinary consumers. And now the Fed has amped up that Main Street aid with these credit facilities. But remember, housing is an important part of that, too. So as goes housing, I believe, as goes the economy. Housing will be the leading indicator for how quickly this economy rebounds from the pandemic.